everybody for making it this evening, especially those who have traveled from Vancouver and Toronto, including our very special guest, Benjamin Tall, Managing Director and Deputy Chief Economist with CIBC. Last year, I summarized with one word something we all had in common, and that word was resilience. The word resilience was one I picked because we've all had to become more flexible in how we live, how we work, and how we conduct business. And without a doubt, we've all had to continue to be resilient. But a word that I would describe what we all have in common today is enterprising. The word enterprising certainly speaks to how we've all had to uncover opportunities during challenging times, have a willingness to take on new projects, and a readiness to undertake risks to achieve success, especially faced with the inflation we've seen, rising costs, interest rates, and of course, global tensions. At Colliers, we've always felt that during times of challenge, our clients turn to us as experts. And we've strengthened our ability here to provide expert advice to our clients. And how we've done this is through ways of making investments in our business by expanding our brokerage team, also adding mortgage brokerage services, and by investing in our in-house market and research so we can provide you with accurate and up-to-date information as required. And this evening, a few of our experts here are looking forward to sharing current market information, and they will help you hopefully make some informed decisions as we move in through the times ahead. So firstly, we'll have an informal panel here hosted by Anna, and then that'll be followed by the best for last, Mr. Benjamin Tall, Managing Director and Deputy Chief Economist with CIBC, who will provide us with some real-time insights on the economy. And on that note, I'd like to thank Phil Lane, Peter Block, and Simon Phil, and the CIBC team for making this possible with Benjamin Tall today. So thank you. Anna?
You can clap. Thanks, Tyler. Probably our panel needs no introduction, but in case anyone doesn't happen to know, we've got Whittaker on the far end. He focuses mostly on industrial. Marc Foucher, who's going to speak a little bit about investment, sales, and land. Graham Smith, our retail expert, and Tristan Spark, our office expert. So as we prep for this, we kind of talked amongst ourselves, and we found that there were probably two topics that we field questions on a lot. One is, what's the office market doing? And the other one is, what are interest rates going to do? So since we have Ben Tall here, we'll let him speak to the latter. But we'll throw some questions out to Tristan first. And you can see all our lovely pictures up there as well. So Tristan, we hear about markets like Calgary that have 26% vacancy, Vancouver doing pretty well, 8.6. How does Victoria match up?
Thanks, Anna. We're doing the best in the country, actually. Our vacancy rate is just below 7%, and that's a healthy number for a balanced office market. We're half the national vacancy rate of 14.1%. We're below our peak vacancy that we hit during the pandemic, and we're in line with our 10-year average, which is 7.3%. We have very little sublease space on the market, about 40,000 square feet out of an inventory of 9 million. The provincial government, who is our largest tenant, has been renewing their leases. And that means we've had little to no erosion on our rental rates, and the market's remaining really resilient and strong. Occupancy levels, that's a different story.
So we've historically tracked vacancy. If anyone remembers Bob Locke, he started it way back when, and Tristan maintains that for our office now. But something we never tracked previous to COVID was occupancy. So can you speak to how occupancy levels are, what they're like and what they're impacting our office market?
Well, the return to office is all over the map, as I think people are experiencing. But in general, we're seeing occupancy levels of unfortunately only 30 to 50% for the most part. It is sector specific. We're seeing the professional firms such as engineers, accountants, lawyers, they tend to be fully back in the office. The public sector is at that 30 to 50% occupancy level. And then at the other end of the extreme, you have what I'd say are sort of internet-based businesses, software design, software development, call centers, where you can go into a 10,000 square foot space and there's only one or two people rattling around in there. So the occupancy levels are certainly causing some challenges for us in the office market.
And how are those occupancy levels impacting space usage?
Yeah, so I think one of the biggest challenges that's facing employers is navigating their space requirement these days. It's frustrating to go in the office, see that there's only 50% occupancy, and wondering, can we replan how we use our office space and get some more efficiency here? So they come up with a plan, let's share some space, let's do some hot desking, go to try and implement that plan with their employees, and it's like they've asked them to come back to work 5 days a week. They're like, if you take away my private desk or my private office, I'm leaving. So that's a really challenging thing for employers to navigate right now. And I think a perfect example of that is the provincial government. A year ago, they announced that they supported hybrid work. And for the entire past year, they've been trying to figure out how to implement that plan. It's been a tough one for them to figure out how they're going to do it. But what I think we will see happening is that the government will give back larger blocks of older B and C class space and replace that with a smaller requirement in newer buildings that focus on ESG principles. Now, I should stress that this is the province. They don't move that fast. This isn't going to happen this year. It's going to be 3, 4, 5 years before we see this fully get implemented. And I think our office market is robust enough that we'll be able to handle that change in stride.
Thanks, Tristan. With one of the things you mentioned was ESG principles. So for those of us who are in the office market all the time, dealing with some newer inventory, we're talking about it, but can you get into that a little bit for those who may not know what our acronyms are?
Certainly. So ESG is environmental, social, and governance. And it's becoming more and more of a focus for companies. We've talked about a flight to quality for a long time. That's still the case, but it's not necessarily a Class C tenant going to Class A in one big jump. There's a flight to quality within the class that you're in. So, if there's any office landlords out in the audience today, my takeaway to you would be nice to your tenants. Make sure you're making those upgrades to your building that are making you best of class. Give them a reason to stay in your building. The other thing I'll say about ESG is I think it's going to be one of the reasons that we see a lot of interest in new buildings like TELUS Ocean, which has a focus on leadership and sustainability. Tenants are willing to pay the premium those buildings are going to require, just so they're in alignment with their ESG goals.
So along with TELUS Ocean, we are seeing some other new supply, both that came on in 2023 and in the future. Some people might be surprised given the softer office market, but can you tell us a little bit about that inventory?
Yeah, I think maybe it's indicative of a bit of a shift as well, but for the past few years, the limited office supply, new supply that we have seen, has been owner-driven. TELUS Ocean, again, is a good example. TELUS are going to take a significant portion of that building. Lake Point Place out in Langford, Lexus built that building for themselves, and they've got some extra to lease out. So that's what we've been seeing. Capital 6 is the first purely spec building that we see coming on, which I think is going to be like a very interesting step for the market to see how that's received. I think it'll be received very well for those ESG reasons that I just said. So overall, I think moving forward, we're going to have some headwinds for the next year or two in the office market, which is unfortunate because the lack of daytime office population that we're seeing downtown is really having an impact on those retail and service businesses that are trying to make it in the downtown core.
Thanks, Tristan. It's like he teed it up perfectly. So Graham, with hybrid work and people not coming into downtown as much, lower occupancy levels, How has that impacted our downtown retail?
Yeah, there's really three things we have to consider when we look at the downtown retail, and the first one really is office occupancy. It has a huge impact on the downtown retail environment. You look at lunch places, coffee places, getting your hair done. All of those things are often done by people who are in the office. They scoot out, get it done back at the office. So those retailers really struggled at the start of 2020 with COVID. It hasn't come back. And so looking forward, definitely very unclear how that's going to go. So that sector is weak. Number two for downtown is the tourist industry. And 2023 was a great year for tourism. So that was a real positive. Lots of retailers who had struggled during COVID did very well last year. 2024 looks very good. There was an article in TC this morning said good things are coming in 2024, so that's really positive. In looking at this Airbnb thing though, there's 1,600 units that are going to be taken off the market in May. So that's the equivalent of 4 Empress hotels. So it's hard to imagine that that's going to have no impact on the market, but hopefully other elements of the tourist market will compensate for that. The third issue with the downtown core that we have to talk about is just the craziness on the streets, to be honest with you. The vandalism, the theft, and the violence on the streets has an oversized impact in the community. And I know this isn't unique to Victoria, but it is very important for our downtown core. So in terms of leadership on that front, I don't really know what they can or should do, but I just hope there is some leadership on that front.
So if we switch from downtown retail, which has some positives and some negatives, what's the broader Greater Victoria, perhaps more suburban retail market doing?
Suburban retail has been excellent. We're at 2.5% vacancy now. Ever since COVID hit, people have been staying closer to home. Suburban retail has done very well. We haven't seen a lot of supply. We've seen a lot of demand. Neighborhoods are growing. So a lot of positive things in the suburban market. I think from a supply side, it's been a tricky market to grow. Where we've seen growth is the West Shores. So Colwood Corners came on stream in 2023. The Commons of Royal Bay came on stream in 2023. Both of those projects effectively fully leased on completion. And that follows obviously with a massive residential growth in those areas.
So with the growth and the success, where's the demand coming from? Like, who are the retailers that are taking the space?
You know, that food and beverage sector is still so strong. Restaurants, for every listing I've got, there's always restaurants. But it's really interesting, the size of a restaurant has really changed. So we used to have the larger restaurants being quite active. Now it's that 1,500 to 2,500 square foot restaurant, smaller staff, smaller management, smaller overhead and footprint. In the larger restaurant category, it's almost like it's a winner-take-all mentality at the moment. So we've got some real success stories in the large footprint restaurants. But if you think about the restaurants that have kind of faded away, like the ABC Countries, the Ricky's, the Denny's, you know, that era of the mid-market casual dining has pretty much disappeared. The other sector that we've seen a lot of activity from, and you've read about it, is the thrifting sector. It's just a thing. So we're seeing those guys be quite active in the market. And then the dollar store, the discount kind of market. So these retailers seeing that the consumer is looking for a way to save money on basics so that they've got some more money to spend where they really want to get some joy out of life.
Thanks, Fred. We're going to shift it over to Ty now. Graham talked about the success that we've seen in the retail and the uptick on the West Shore market, primarily being driven by the population growth. With that, we're also seeing a huge amount of industrial inventory coming on there. Can you tell us what's coming and how that's going to impact a really tight industrial market?
We have an inventory base of 9.65 million square feet, and we have over half a million square feet being built out into the West Shore, and a lot of that is purpose-built planned strata. And it's interesting when you look at these projects, they all are serving a certain niche. They're not competing against each other in size. They're all about the same price point. But when you look at 500,000 square feet on average being delivered in one fiscal year, our annual absorption over the last 23 years has been only 100,000 square feet in good and bad markets. So, we are nearing completion and occupancy of a lot of these projects, and they're all over the map in terms of how many have been sold. But there's definitely going to be some units that are going to be for sale, and that's going to have to slowly be absorbed over time. The West Shore is going to have, as of Q4, a vacancy of 5.1%. The rest of the market is darn near zero and performing very, very well. The good news is, you used to have conversations with decision makers who are running businesses, and I'm not moving out to West Shore. I'm not doing a drive. And all of a sudden the light's gone on, and they realize, one, the residential market has been exploding out there, slowing down a little bit. But a lot of their employees now are living out there, and it makes sense for them to establish their business in these pro-business communities. So, growth has happened, and it's going to get gobbled up in the next year, and I do think the developers are going to be able to maintain the values that they are trying to sell right now.
So with that and the amount of inventory that we're coming on, if anyone's thinking about it, is there opportunity for more?
There certainly is. Most of our business parks, the mature ones, Keating, Royal Oak, downtown, Sydney, are all full, 0% vacancy. And there's a lot of these large multinational groups that are coming into this growing city that we have, needing to have more sophisticated real estate, better logistics, better racking, higher ceilings, more modern facilities. And right now there's 2 or 3 groups in the 40, 50, 60,000 square foot bulk warehouse requirements. There's only a couple of groups that are now ready to be able to deliver to that. So I see bulk warehousing still being an opportunity for some. And the other market category is land. A lot of these developers came in, bought up land, and put as much density on they could to try to turn a profit. There's not a lot of land available for those groups that need yard space, machinery and equipment laid down, and they need to be close to our urban core. So, that's another category that we're going to see. If land become available, it's going to get gobbled up.
So with the shift of the inventory being built out on the West Shore, but still being demand in the core, how do you think this is all going to play out with this new inventory?
I think it's ultimately going to play out in a very positive manner. It's interesting looking at what has happened across Canada, and it's the same thing's happened in Victoria here, is rental rate appreciation that's taken place. And, we used to, I remember when I started 25 years ago, $7 was the rent, net rent. And every year it just kept getting more and more and more. And, what used to be 2 or 3 years ago, $16, $17 a square foot, all day long, the average now is $20.40. And we're doing renewals now with groups that are coming off that $14, $15 a square foot. And they're paying $20, $21 a square foot with a nice healthy CPI bump. The opportunity is owning some of this industrial real estate and seeing that appreciation take place, and it's still a really good category to be in.
So investing in industrial seems pretty good. Marc, we're going to move over to you to talk a little bit about where the rest of our investment market was. How did 2023 stack up?
Thanks, Anna. So I'm going to give you guys some numbers here. In 2023, the total transaction volume in Greater Victoria area was $750 million. That's down about 46% compared to the $1.4 billion we saw in 2022, and it's down about 62% compared to the $2 billion we saw in 2021. We go down into specific asset classes. Office sales, they saw a decrease of about 71%. Retail saw a decrease of about 57%. And land saw a decrease of 59% compared to 2022. As Ty mentioned earlier, industrial was probably the most stable with a decrease of only 9%.
And now to your baby, the beds of the beds and sheds. How did our multifamily market play out?
Yeah, so the multifamily market led all asset classes last year with about $450 million in total transaction volume. However, that's still down about 45% compared to 2022. When all the other asset classes, so when interest rates hit their peak last year and all other asset classes needed to see a capitalization rate in the 6 to 7% to make sense of an acquisition with traditional financing, that's where the multifamily market remained strong. Is they were able to, or buyers were able to take advantage of some favorable CMHC financing, which is usually 35 to 45 basis points above the posted Canada bond rate, depending on obviously the strength of the borrower and the deal size. That's not to say that multifamily obviously didn't have its own challenges. Of course, interest rates affected that, and because CMHC financing was so attractive, there's a huge backlog of applications waiting to be processed, so that slowed things down for sure. Now, that decrease in transaction volume that I touched on earlier, a large part of that was institutional money being sidelined last year because of the high interest rates. But in that void, we did see private capital come back to our market, and we saw very active non-for-profits taking advantage of the BC rental protection fund.
So with institutional buyers going away, what do you think they're going to come back? What's going to bring them back?
Yes, I'm confident we're going to see them come back. They didn't completely go away. There were still a couple of big transactions, but now with interest rates hopefully hitting their peak and maybe starting to come down, I'm pretty confident we're going to start to see them come back for a couple of reasons. Mainly the appetite for new build product. With new build product, the institutional funds, they love this product category for a couple of reasons. One is new buildings are far more efficient. Two, there's ESG commitments that these funds have to meet across their portfolios, and new build offers that opportunity. And then also you have the ability to control your own lease up. So, and then on top of that, I think the thing that we kind of overlook quite a bit is there's a big portion of renters that maybe would normally be buying their first condo right now but can't because of where interest rates are at, but they still want a high-end rental experience to match their lifestyle, and new build product will offer that. I think to put that in perspective, the new build apartment segment in Victoria, we saw about 5% growth in 2023, which was pretty similar to what we saw in 2022, but that's double the 10-year trailing average of about 2.5%.
So it sounds like there's an appetite for the new build. Where are we going to build it? And where do we find land? How do we make the land deals happen? So what transpired in 2023, and what do you think will happen in 2024?
Yeah, I don't think it's any surprise to anyone in this room that land has been and continues to be a pretty challenged asset class, with borrowing costs for construction reaching 9%, hard costs on wood frame apartment buildings anywhere from $400 to $450 a square foot. Big equity requirements, huge pre-sale requirements, and you combine that with rental rates that are, probably hit their peak, and condo buyers that can't afford what they used to anymore. It's hard for developers to underwrite a positive return on these developments. To put that in perspective, in the West Shore alone last year, we saw a decrease of about 70% in land sales. And in the city of Victoria proper, we only had 4 land sales for multifamily sites, all under 10,000 square feet. So we are seeing more sites come to the market, and in this year we expect to see the same, and we're probably also going to see more court order sales come to the market. Now, There are some positive conversations happening at the municipal and provincial levels about trying to cut down that rezoning timelines and getting your permits. So that's good. The GST was eliminated on new build apartment buildings, so that's going to help. On the flip side though, you saw an increase in the building codes last year, and next year, 2025, the seismic code increases are going to come into effect. So people are already anticipating that's going to push the hard cost construction for, say, a wood frame apartment building north of $500 a square foot, which isn't going to help with affordability.
So with all those challenges, how are deals happening? How are they getting done?
I do want to end on a positive note, and that is to say that, yes, land deals are still happening. It's not all doom and gloom. So sites that we bring to the market that are rezoned or have their permits in place, and there's a pretty clear path towards a completion on that for buyers, those are well received. There's just so much less risk with those. And then sites that aren't maybe rezoned or don't have permits in place, what we're finding success with is just sellers who are patient. So if you're an owner of land and you're willing to work with the buyer on providing a longer due diligence period to get the financing, which is harder to get these days, maybe you're willing to work with them on an extended rezoning application, maybe provide them with a longer closing period, those deals are getting done. So, my advice to owners of land out there is just be patient and the deals will come.
So it sounds like we still have a few things to look forward to in 2024. Hopefully some things will happen. We all hope they happen. So I'm going to shift it a little bit, trying to keep things a little bit fun for you guys. And trying to get ready for this, you're coming to us, you're wanting information from us. But sometimes it's kind of like talking to my 7-year-old. Like, how's your day at school? Fine. What'd you learn? Nothing, right? So trying to pull a little bit more out of these, our experts for you guys. So, what made you cry? What made you laugh? Did you have fun? Or what excites you for 2024? So, Ty, can you kick it off?
Well, there's been some tears in the last 18 months. I think we've all gotten punched in the nose a little bit. I think there is a sense of optimism with everybody I talk to that, our buddy Tiff has maintained interest rates to be somewhat consistent, which at least gives us an understanding that we're not going to be going further north, and that people can now hopefully walk into their bank, and banks are back lending. And I do see that leveling off is giving the market confidence. And I think the most important thing is we live in this wonderful community. There's growth happening. We've had tremendous growth over our careers, and that's going to come back. And we've had a little bit of a blip, but I'm really optimistic for the balance of this year and certainly the next 5 years going forward.
Thanks, Ty. Now, Tristan, besides cars, what excites you for 2024?
What excites me in the office market? What excites me in the office market is the new product that is going to be coming on stream with TELUS Ocean and Capital 6. A lot of the new products in Victoria is already a step change above our existing stock, but I think this next level is just going to push that envelope even further in terms of building efficient design and leadership in all those areas. And even more so, just the atmosphere. They're very tenant-focused buildings. They've got fantastic end-of-trip facilities. They've got gyms that are almost spa-like in them, fitness facilities. They've got almost entire floors that are common area with decks with beautiful views and shared boardrooms for tenant to use. So it's really a tenant-focused concept moving forward with beautifully designed buildings. And I think that's really going to help us get people back in the office because it's a place they want to go to. So with talking about the occupancy levels before, I think that's going to be a big help for us. So I'm excited about that.
Thanks, Tristan. Graham?
It's been so hard the last few years. You get a deal done, and then you try and get the trades to come and help you do the TI, the build out, and it was very difficult to get trades. It was very expensive. Within the last couple of months, we've actually had people calling us saying, I've got a window. Do you have some work for me? So I'm optimistic, Anna, that maybe in 2024, we get a little bit of cooling on that construction side that allows projects to happen more smoothly and more cost effectively.
And Mark?
I'm cautiously optimistic that the message I think everyone in this room has been sending towards the municipalities in regards to the wait time on rezonings and getting your permits, I think that it's definitely making its way through, and I think we're starting to see the first maybe real initiatives from those municipalities. So I'm optimistic that, you know, if there's maybe a delegation of work between council and planning, that is actually going to help speed up these applications and get more buildings built.
Well, thank you all. We're not quite done. We're going to have a little bit of audience participation now, changing it up again. So last year, when we were on the panel, we had a question asked to us, you know, if you had $10 million, where would you put it? And if anyone remembers, Ty's answer was targeted GIC. So we're going to do a little show of hands at multiple choice. One, who's going for the GIC? Two, well-located, good rent roll office building. Three, industrial product in Rock Bay. Four, suburban retail. And five, 30-unit multifamily building. So, option one, park it in the GIC. Okay, we got one. We got one. Option two, a well-located, good rent roll office building. We got one. Okay. Industrial in Rock Bay. Okay. Got a few. Suburban retail. Our friends at Anthem at the back. And a 30-unit apartment building. Okay. I think it's actually a toss-up between the industrial and the retail. I like it. Well, thank you guys so much. That's the end of our panel for today. I'm going to turn it back over to Tyler.